Good morning, and welcome to today's webcast, What to Know About 280G Golden Parachute and When It Applies. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Jennifer Menendez, Managing Director, and Sami Chehrzadeh, Senior Manager. Jennifer has been practicing at Moss Adams for 18 years and leads the firm's transaction tax projects group, serving both privately and publicly held companies, as well as private equity firms in several industries. Jennifer has extensive knowledge and experience in tax structuring, modeling, tax due diligence, Section 382, Section 280G, transactional cost analysis, QSBS, and other transactional issues. Sami works closely with private equity firms, public and privately held companies, advising them on buy-side and sell-side transactions. Her experience includes serving clients in a wide range of industries with tax structuring, tax due diligence, modeling, legal entity rationalizations, and other tax consulting assistance. So with that, I will turn it over to Jennifer to get us started.
All right, thank you, Chad. Welcome, everyone, and thank you so much for joining us today. As Chad mentioned, we are going to be talking about the basics of Section 280G today. And I'm going to briefly go through this agenda for today. First, Sami will be kicking us off with some background of 280G and why it's an important consideration. Going through some of the congressional intent and some big penalties that can apply to the extent that 280G does apply. She's also going to be talking about a general overview of the basics of 382, when and how it applies, and going through some key terms. And then she's going to be talking about some common examples that we see of parachute payments. And then I'll be going over some mitigation and planning opportunities around Section 280G, including the shareholder approval process, a reasonable compensation exception, and then going to briefly talk about just the impact on due diligence to make sure you're not caught off guard when 280G might come up in a transaction. And then after that, we're going to leave a few minutes as well for any Q&A that might come in throughout the presentation. And with that, I'm going to turn it over to Chad for our first polling question.
Awesome. Thank you, Jennifer. And our first polling question of the day, what brings you here today? Either A, I'm in the process of assisting with a sale of my company. B, I'm considering acquiring another company. C, I have questions about setting up or executing compensation plans for our executives in the near future. Or D, none of the above. I'm just here for the CPE. So if you select the answer on your screen and hit the submit button, your polling question will be recorded today for CPE. And we'll give you about 15 to 20 seconds here to answer this polling question. All right, we're almost at 90%, so we'll give you about 5 more seconds here. All righty, how about we check out the results?
All right, so about half of you are just here for the CPE, and that's great. Happy to have you. And it does look like some of you are looking at, a sale or an acquisition, or maybe have some questions that if you're thinking well in advance of a sale or a transaction, and maybe just thinking about how you're setting up your compensation plan. So that's great. Happy to have you all here. With that, I'm going to turn it over to Sami.
Thank you, Jen. So why is Section 280G an important consideration? Section 280G was enacted to discourage excessive compensation to executives of a company in the context of corporate acquisitions. Such large golden parachute payments were viewed by Congress as excessive and disadvantageous to shareholders and lowered the selling price for target stock. Additionally, such payments discouraged potential buyers and encouraged transactions that were favorable to management that may be contrary to shareholder interests. Golden parachute payments reduce amounts otherwise payable to target shareholders. And so Section 280G was enacted, and Section 280G penalizes both the company and the executive receiving the excess parachute payment. So to the extent there is an excess parachute payment, the impact on the corporation is that it loses the tax deduction for the payments. There is a reporting requirement either on a W-2 or a Form 1099 miscellaneous, and there's a withholding requirement for the excise tax if the payments are considered wages. And the individual receiving the payment is subject to a 20% excise tax under Section 4999, in addition to regular federal and state income taxes. So the federal and state income taxes, together with that 20% excise tax, could subject the payment to a tax rate in excess of 70%, assuming the individual is in the highest income bracket, which could be a pretty harsh result. And so a company will want to strongly consider this result when anticipating that the individual will continue working for the company post-transaction. And so moving on to a general overview and key terms, first you need to consider whether the target company is subject to Section 280G. And Section 280G only applies to corporations. For 280G purposes, an affiliated group of corporations are treated as a single corporation. And then S corporations are exempt from Section 280G, and this includes a C corporation if it could qualify as an S corporation, but no election is made. For C corporations that could qualify as an S corporation, this determination is made without regard to Section 1361B1C, which means that a corporation could have a foreign shareholder so long as the other requirements are met, such as one class of stock, no more than 100 shareholders, etc. And 280G is not applicable to partnerships. However, you will need to look out for partnerships that have a C corporation in the structure. The rules are gray with respect to partnership structures with a C corporation, so companies tend to take a more conservative approach and prepare a Section 280G analysis and get the shareholder vote or do clawbacks to mitigate the result, which we'll get into more detail later in the presentation. So next you'll want to determine who are the disqualified individuals. The determination period for determining who is a disqualified individual is 12 months prior to and ending on the date of the change of control. And generally, this includes individuals receiving compensatory payments, such as employees, independent contractors, or directors that fall under one or more of the following categories. Shareholders that own greater than 1% of the fair market value of all the stock, including vested options. And these are vested options that vest as of the control date as well, and restricted stock with Section 83B elections. The next bucket is officers that have the title of an officer or the authority of an officer. This category is where we see the most gray area, particularly with vice presidents and managing directors, where they do not have the title, but they have the roles and responsibility. So companies tend to take a conservative approach and include them, or document why they should not include them. This determination is based on facts and circumstances, and there's a presumption if the individual's title includes the word officer, that the individual is an officer of the company for purposes of Section 280G, unless the facts and circumstances demonstrate that the individual does not have the authority of an officer. The last bucket is highly compensated individuals. This is the lesser of the highest paid 1% of employees or the highest paid 250 employees. So, for example, if a company has 200 employees, which is the highest number in the 12 months preceding the change in control, the two highest paid employees would be considered highly compensated individuals. And usually we see this with officers, but we've seen it include others such as vice presidents, directors, business development employees with high commissions. It's also important to note that some disqualified individuals may fall into more than one bucket. So next you'll want to determine whether there will be a change in control. There's three general categories that are considered a change of control. The first being change in ownership of the corporation, the second being change in effective control of the corporation, and the third being a change in ownership of a substantial portion of a corporation's assets. So a change in ownership of the corporation is when a person or group of persons acquire stock that exceeds 50% of the fair market value or total voting power of the stock. This is what we see most commonly. The next bucket is change in effective control of the corporation. Generally, we see this one of two ways. So when any one person or more than one person acting as a group acquires in a 12-month period 20% or more of the total voting power of the stock of the corporation. Or this could occur when a majority of the members of the company's board of directors is replaced during any 12-month period when not endorsed by a majority of the corporation's prior board of directors. Lastly, a change in ownership of a substantial portion of the corporation's assets. This is when the gross fair market value of greater than or equal to 1/3 of the total gross fair market value of all assets of the corporation are acquired. Next, you need to determine each disqualified individual's 3 times base amount under the safe harbor. And so the base amount is the disqualified individual's annualized includable compensation for the base period. And so this is W-2 Box 1 wages or 1099 amounts. Next, the base period is the most recent 5 taxable years ending before the date on which the change in ownership or control occurs. So here, for example, if the transaction is occurring in 2024, you will be looking at 2019, 2020, 2021, 2022, and 2023. Here, you want to be careful for transactions that may occur towards the end of the year and actually close the beginning of the following year, because you'll have to update that base period. So, for example, if you have a transaction that is looking to close the end of 2024, but actually closes beginning of 2025, you need to update that base period to include 2024. And then the safe harbor amount is calculated by taking 3 times the base amount. And so you'll have a parachute payment to the extent the contingent payments exceed the safe harbor amount. You'll also have to back out one-time payments like signing bonuses in an annualization year. And then if an individual is hired as a contractor and later becomes an employee, you'll want to include all of those years, which can actually reduce your base amount. And then if an individual is hired in the year of the change in control, you annualize that pre-change in control compensation and you exclude the parachute payments. So for example, if an individual was hired at the beginning of this year, you will annualize their payments for 2024, but you would exclude any parachute payments that they're receiving. And then the base amount also includes, sorry, want to say something, Jen?
I was just going to jump in. We got a question from the audience back on the disqualified individuals. Just real quick, if we go back to the officers, the question was on, the maximum number of officers that could be considered disqualified individuals. And that is correct. There is a limitation on that. And what that is, the higher of, the highest paid 50 employees or 10% of employees, or if it's less. Than it's employees. And of 20 officers, there's usually not 20 officers in a 200-person company, but there are times that we have seen it limited if there are just an extensive amount of officers. But sorry about that. Same, let me jump back to your
thank you.
Slide.
So I just wanted to add one other point. So for the base amount, this also includes compensation from a predecessor entity and or a related entity. So you'll want to consider that. So what are the contingent payments for each disqualified individual? They are compensatory in nature, they're paid to a disqualified individual, and they are contingent on a change in control. And for determining whether it's contingent on the change of control or an event closely associated with the change of control, it's treated as contingent unless it is substantially certain that the payment would have been made otherwise. And then payments that become vested upon a change in control are automatically considered a contingent payment. For events materially related to the change in control, there's a presumption if the payments are made within a year before or after the change in control that they are materially related. And then there are certain events in the regulations that specifically are presumed to be materially related to the change of control. These events include the onset of a tender offer, a substantial increase in the market price of a corporation's stock over a short period preceding a change in control, cessation of listing of the corporation's stock on an established securities market, the acquisition of greater than 5% of the corporation's stock by a person or group not already in control of the corporation, the voluntary or involuntary termination of employment of a disqualified individual, which we'll get into a little bit later, and a significant decrease in the disqualified individual's job responsibilities, and then also change in ownership or control as defined in the disqualified individual's employment agreement. In order to rebut this presumption, you must have clear and convincing evidence.
So one of the most, I think, common issues we see falling under that is severance. And I think we're going to talk about that a little bit later as well. But I think, so when we're doing a 280G analysis, a lot of times we'll have, the company will say, well, no, we're not going to terminate any employees as part of the change in control. But a lot of times you want to conservatively include those amounts to see kind of where you're at. Because if that employee is then terminated any time within that 12-month period after the change in control, then that presumption applies and those amounts get pulled back in. So what you don't want to do is not include it, think that they're under the safe harbor amount, and then later, trip over that and then have to go back and you basically, you can't fix anything at that time. And then you could have a large excise tax at that point in time.
So next, you'll want to determine if there are parachute payments. So to the extent the total present value of all contingent payments exceed the safe harbor amount, you'll have parachute payments. Again, that safe harbor amount is 3 times the base salary. The excess parachute payment is the excess of parachute payments over the portion of the base amount allocated to such payment. So in other words, once you have parachute payments, the excess amount is actually the amount over 1 times the base salary. And present value is determined as of the date of the change in control. And so some common examples of parachute payments that we see pretty frequently are transaction bonuses, severance payments, and continued payment of health, such as COBRA payments, welfare, fringe benefits. As Jen mentioned, with respect to severance, if an employee is terminated within any time of 12 months of the change in control, either before or after, it's presumed to be contingent on the change in control. So conservatively, this is included in calculations, as it's hard to predict whether a disqualified individual may be let go within 12 months of the transaction. Another bucket of parachute payments include equity incentives, such as stock options or restricted stock. With respect to equity incentives, if they're issued within 12 months, we include the full intrinsic value unless the presumption can be rebutted. If they are fully vested without regard to the change in control, they're generally not considered a contingent payment. If the vesting is accelerated with the change in control, so if some services are provided and absent this change in control would have vested conditioned only on the individual continuing to perform services for the corporation for a specified period of time, we calculate to value the acceleration and the lapse of service requirement. So in other words, here it could be significantly less because it's just the value of vesting that's being included. And then if the vesting is performance-based, we include the full present value. Other examples of parachute payments include payments in the prior 12 months, including increases in compensation, new agreements that are entered into, new equity grants, retention payments that are agreed to prior to the change in control, management incentive plan payments, and then accelerated or prorated current year bonuses. And one question that we commonly get are, what are some payments that are exempt from Section 280G? And in general, there's 5 types of payments that are exempt from parachute payments in the 280G regulations. This includes payments from an S corporation or a company that could qualify as an S corporation immediately before the change in control, which we discussed earlier, a non-public corporation that obtains shareholder approval. We will go into this more in detail later. Payments to or from a qualified plan, and then payments made by certain tax-exempt organizations. And lastly, certain payments of reasonable compensation for services to be rendered on or after a change in control. And this brings us to our second polling question.
All right, thank you, Sami. And our second polling question of the day: executives at my company are most commonly entitled to the following upon a change in control: A, accelerated vesting of equity awards; B, transaction bonuses; C, severance payments; D, something else; or E, several of the above. So we'll give you about 15 to 20 seconds to answer this polling question. If you select your answer and hit the submit button, your polling question will be recorded today. All right, we're hitting about the 90% here, so we'll give you about 5 more seconds to answer this one. All right, How about we check out the results?
So it looks like we're pretty split up over here, with the majority being accelerated vesting of equity awards, which is something that we see most common. But we do see a combination of all of these things. And again, with respect to severance payments, I think it's important to note to the extent a disqualified individual is entitled to severance payments, we'll conservatively want to include those. And with that, I'll hand it over to Jen.
Thanks, Sammy. I just wanted to address real quick before we move on regarding the equity awards. We did get another question from the audience, and it was, if a disqualified individual's stock options accelerate upon a change of control, but the individual is not terminated upon the change in control, are they still subject to the 280G calculations? And the answer to that would be yes. I think, that there's still a value in that acceleration, and because that acceleration is happening related to the change in control, that does get pulled in as a parachute payment, even if that individual is staying on after the fact. And with that, I'll move on to the next slide. And I'm going to talk a little bit about potential mitigation and planning around Section 280G. And the most common thing that we see to help with 280G is the shareholder approval process. So since the intention of Congress with Section 280G, as Sami mentioned, was mostly to protect the shareholders in a transaction, the regulations permit shareholders of a privately held corporation to have a vote to exempt those payments from Section 280G. And as far as privately held, to the extent a company has anything that's readily tradable, then they're not considered privately held. But otherwise, they're allowed to go through this vote. And in order to qualify under this exemption, they have to meet the following voting requirements. So first, it must be approved in a vote that is separate from the vote approving the change in control transaction. So in other words, the transaction or the change in control cannot be contingent on having a successful approval of the payments. Second, the vote must determine the right of the recipients to receive the payment, or if it's a payment they've already received, the right to retain that payment. So generally, what we would see here is that the individuals will sign a waiver agreement, and they'll waive their rights to those amounts to then put them up for vote. And you don't have to waive the entire amount of your payments. The most common thing that we see is that the payments in excess of that safe harbor amount, with maybe some additional, safety room around that, not within $1 or a cent, but usually those excess amounts are what are put up to vote. Because then, to the extent that there is an unsuccessful vote, the individual can still retain the rights to the payments up to that safe harbor and then not have a 280G impact on those. So there also has to be adequate disclosure to all shareholders of all material facts concerning all potential parachute payments. So usually what this means, it usually entails doing a full 280G analysis to have all of those details and those numbers that then have to be included in those shareholder disclosure documents, including the base amounts and excess parachute payment amounts, what type of payments are applying. And this is where, the accountants, ourselves or others will work closely with legal counsel to provide that information. And then that goes into those legal documents that go out to the shareholders. And the purpose of this, as far as the disclosure to all shareholders, is the IRS wants to make sure that all shareholders, including minority shareholders, have a good understanding of the amounts of the payments, and they have a reasonable opportunity to object to such payments. Now, the payments are approved, also have to be approved by a vote of the persons who owned immediately prior to the change in control more than 75% of the voting power of all outstanding stock. And for this purposes, for the 280G purposes and this 75% threshold, disqualified individuals that have excess parachute payments are excluded from the vote. So in other words, if you're one of the shareholders receiving payments that are being voted on, you are not entitled to vote on any of those. Those shares owned by that disqualified individual are then excluded from both the numerator and the denominator as far as looking at, percentage of shares outstanding. And that determination of the shareholders entitled to vote can be based on the shareholders of record as of any day in the period that starts 6 months prior to that change in control. And we have seen, scenarios where, there might be a majority shareholder that is also a disqualified individual. And, I've seen one where, it was a CEO that felt it was very important that the other executives, got their approval. And so he basically gave up his rights and gave up his payments so that he wouldn't be one of those with excess parachute payments, and so that he could be part of that vote to approve the payments. So there is some, planning that you can do around that. All right, and move on to the next slide. So just some important considerations as the company's thinking about whether or not to go down this path of shareholder approval. It's important to know up front, where the company stands as far as whether it is an option or not. And, one of the considerations is just the general makeup of the shareholder group investors. A very common situation where we do see this as a successful option is, where there's private equity involved or venture capital, and maybe they have a majority share. And in that case, it's usually you pretty much have that confidence in a successful vote. There's a reason why a lot of these payments and incentives are put into place, and it is to encourage and those executives and retain them. And so usually that is a scenario that we see go through a fairly smooth process. Conversely, if a company is very widely held, it might not be practical. It might be a huge administrative burden. And in that case, there are times where a company might decide, that's not something that we see as an option. To the extent that there's a shareholder that is an entity shareholder rather than an individual, generally that approval can be made by any person that's authorized by the entity to approve payments. However, in instances where that entity's stock in the corporation constitutes a substantial portion of that entity's assets, then the vote has to pass through to the investors in that entity. And so for that purpose, a substantial portion is determined to be, if it's more than a third of the fair market value of the assets. So where we would commonly see that is, especially if there's a pass through that's more of a holding company and the only thing they hold is that corporation stock, then that vote will then have to pass through to the investors in that entity. So again, another key factor is how much confidence there is in a successful vote. If you can't get management and the individuals that are receiving the payments comfortable that, we think this is going to be approved, a lot of times those executives may not want to sign waiver agreements because they could be better off, even if they're subject to the excise tax, it's still something instead of nothing, if they potentially lose the payments altogether. And then another common thing that we see is just management's willingness to disclose executive compensation detail. So again, the disclosure of the details has to go to all shareholders. So you can't just say, okay, well, this private equity firm owns more than 75%. We'll just tell them and disclose to them, and then they can approve it and we're good. It has to go to everyone, including minority shareholders. And so I have seen scenarios where a company might have several employee shareholders, and company management might not feel comfortable disclosing all the historical wage detail and compensation detail and the contingent payment detail to all those employee shareholders. And so in that scenario is another hurdle to get over. All right, we've got our next polling question.
Awesome. Thank you, Jennifer. And our third polling question of the day. Do you think a shareholder approval process would help if a change in control occurred in your company? Either A, yes, B, no, the company is a public company, C, no, we wouldn't want to disclose the details to all shareholders, or D, no, it wouldn't be practical with the shareholder group. So like the other two questions, we'll give you about 15 to 20 seconds here to answer. If you just select your answer and hit the submit button, your polling question will be recorded today. All right, we're getting to about 90%. Give you about 5 more seconds here. All right, let's check out the results.
All right, great. It looks like a large percent is yes, it would be helpful. Some it's a public company. And then I think it is a very real thing as far as wanting to, be careful about the disclosing of the details to all the shareholders, or it not being practical as well. All right. So the other, kind of mitigation opportunity that we see is the application of clawbacks. And so it's common to see clawback language in employment or payment agreements. For example, this would basically say, to the extent that there are excess parachute payments, those payments will be clawed back or reduced to an amount that is less than the safe harbor amount. Or it could potentially be worded that it is reduced to the amount that is most beneficial to the individual on an after-tax basis. And we see that very commonly as well. And what this is that basically an individual will only have the excise tax if there are payments in excess of the safe harbor amount, which again is 3 times their base amount or their average comp for the last 5 years. However, once that safe harbor amount is exceeded, that tax will apply to everything in excess of 1 times the base amount. So this means that there are situations where the individual will be better off giving up some of their payments, accepting lower payments to get them under that safe harbor amount so that they basically could end up with more cash net after tax. And it's important when looking at, the clawback provisions that you take into account all potential parachute payments. So one thing we've seen, in some older employment agreements is, maybe in a severance agreement, it'll say, but the severance will be clawed back to 2.99 times the base amount. But when that language doesn't take into account, the totality of the payments that could be out there, it might not help at all, really, because as soon as those payments are even $1 over that safe harbor amount, so that means in that scenario, if they had that severance up to 2.99, if they had another $1 of some kind of benefit and they get pushed over, that safe harbor amount, then they'd still be subject to the excise tax. So just something to look out to in that language. And then I just wanted to briefly mention gross ups. We're not going to spend a lot of time talking about those, but historically, some companies have paid a gross up amount to make the individual whole for any excise tax paid. However, that amount can be very significant. As then you have to also gross up the gross up payment, right? For what is, potentially, like Sami mentioned, 70% or more of tax. And so when you're dealing with that large of a tax impact, the amount of the gross up ends up being, a very large amount to compensate for that. And due to that, we've rarely seen these provisions applied recently, as they are seen as excessive and detrimental to the shareholders. I'm going to quickly go through a very basic example of, how a clawback would apply and that net benefit after tax. So in this example, say you have a base amount of 100 and parachute payments of 400. And again, we're going to assume about 50% federal, state, regular income taxes. And then we've got the 20% excise tax on top of that. So the safe harbor amount would be 3 times the 100 base amount, so 300. And then the excess parachute payments, so since the parachute payments of 400 exceed the 300, the excess parachute payments is everything over, again, 1 time, so the 100. So we've got 300 of excess parachute payments. So on the 400, if we have regular income tax, like we said, of 50%, that's $200. Plus we've then got an excise tax of the 300 at 20%, so $60, with a total tax impact of $260. So in this scenario, the net benefit to the individual is only $140 on the 400 of payments. If alternatively, we did apply a clawback to that amount and we say, okay, we're going to reduce that 400 of payments down to $299, then on that $299, they won't be subject to the excise tax because the $299 is less than the safe harbor amount. So none of that $299 is subject to the 20% excise tax. They will still have regular income tax, so about $150 of half of that. And there, the net benefit to the individual is, $150 out of the $299, or $149.50, I guess. And so that amount is, even though, their payments in total are less, their net benefit of about $150 is greater than their benefit of $140 in the first scenario. So obviously these are very small numbers and it's just for purposes of understanding the concept. But as those numbers are much larger in a transaction, it can be significant. So another exception that we see applied is reasonable compensation. And what this is that to the extent that there's reasonable compensation for services that are performed after the change in control, they're not considered parachute payments to the extent that there is clear and convincing evidence that such payments represent reasonable compensation for services. So this is a good option out there to rely on, but it can be difficult as it is very subjective. And again, it has to be clear and convincing evidence. So the company has that burden of obtaining that evidence, showing that evidence, and there might be some uncertainty in that. So it can be difficult to get all the parties involved, the individual, the company, buyer, to be comfortable relying on this approach unless you have a very clear set of facts and circumstances and great evidence to support it. So again, it is subjective and it's a facts and circumstances based determination. Some of the key factors to consider are the nature of the services to be rendered, the executive's historic compensation for performing such services, and then compensation of similarly situated employees working for comparable employers. And one note on this, again, on severance payments, they're specifically excluded from being treated under this exception as reasonable compensation. I also wanted to mention there is an exception also for reasonable compensation for services provided before the change in control. However, the mechanics of that rule works differently, where the amount is still included as a parachute payment for purposes of determining if you've exceeded the safe harbor amount, but then it can be excluded for purposes of calculating the excise tax. So if it's reasonable comp for before, it's not quite as helpful because usually you're trying to get under that safe harbor amount. And so, but it can still be helpful if in reducing the total excise tax. And then one of the things we commonly have seen in the past around planning here is related to non-compete agreements. And the regulations specifically say that you can fall under this exception for payments that are for refraining from performing services as well. But you must demonstrate, again, clear and convincing evidence. And here is that the agreement substantially constrains the executive's ability to perform services, and that the agreement will likely be enforced. So this includes, considerations around the individual's desire to compete, their ability to effectively compete, the feasibility within the market of effective competition. And then other factors considered include, that individual's economic resources, their business expertise within the industry, contacts and relationships with customers, suppliers, or other contacts of the company, and then the buyer's interest in eliminating competition. And then again, here there has to be the ability for it to be enforced and the likelihood for it to be enforced, and that could be highly subject to different state laws, as well as most recently, I think it's going to change, the ability for us to rely on this exception and non-competes, as the FTC very recently passed a rule on April 23rd that's banning non-compete agreements. So under the final rule, the existing non-competes with senior executives can remain in force, but other existing non-competes cannot be enforced, and the companies will be prohibited from entering into or enforcing new non-competes. So this rule is, like I said, it was very recently passed. It hasn't gone into effect yet. I believe it's 120 days when it goes into effect. And I do think it will probably face some legal challenges and, maybe before it gets completely enforced. But that's something we just have to wait and see. But I think it will definitely have an impact on, this option is around non-compete. To the extent that we are trying to rely on non-compete, it also does require, a formal third-party valuation. And generally what this involves is the income-based method, which is a discounted cash flow of the difference of projected cash flows with competition and without the competition. And then a key factor here is that valuation is still subject to the reasonable compensation test. And so in practice, we often see this limited by, again, you're going up to these factors up above, including, the executive's historic compensation for performing services. So it might be difficult to show, you might be able to come up with a large valuation of this, but then let's say it's a non-compete for a period of 1 year, which we've seen commonly, there's the question as to can the value of refraining from services for that 1 year be greater than what they would have been paid if they had actually provided services for that year, and would that be reasonable? And I think that is often, kind of a limitation that gets placed on that opportunity to plan around that. And then I just wanted to briefly talk about just the general impact on the due diligence project. I think from the sell side, a lot of times what we see is that, maybe the company hasn't even thought about 280G at all until buyer comes in and is doing their due diligence. And sometimes it's more towards the end of the process that they might ask, has the company considered 280G? Are you doing an analysis? And to the extent the company hasn't thought about it until that point, it can really be an issue with, either delaying the timing of a deal, or to the extent those compensation, issues are a big issue to the deal, it could potentially even kill a deal. So I think it's important to understand and get ahead of it. And I know that's why a lot of you are here today, so that's great. But it's always just looking at, on the sell side, considering the impact early on, even before you're even thinking of a deal, when you're drafting employee compensation plans and looking at, thinking ahead as to how that's going to work, if there is a change in control and what the impact would be. And then also looking at, some of the opportunities to mitigate any issues around it. Like we said, whether it's clawback language in the agreements, or, being ready and set up for a shareholder approval process. And some of that's just kind of communication ahead of time to the shareholder group. And then from a buy side perspective, the reason the buyer is going to come in and say, hey, have you done an analysis? Can we see the analysis? Are you doing a vote? Especially if they're seeing large compensatory payments that are being made, or a large amount of stock options that are getting accelerated or cashed out upon the deal. From the buy side perspective, you do want to make sure that you're seeing that, understanding that. And the reason for that is that, it could cause historical exposure. So in the pre-change period, if it's not reported accurately, then, the company is likely going to deduct those payments. And then that can trigger, some historical exposure for the tax that should be paid on that amount if they were not allowed a deduction to the extent that there are excess parachute payments. There's also, as Sami mentioned, a withholding and reporting requirement. And so there can be some exposure there as well. And then sometimes there are even, parachute payments that are potentially made post-transaction. Like I said, maybe there's someone that's terminated and it's severance and then that triggers it. And that could be a loss of a deduction even in the post-change period for the corporation. So buyers going to want to think about all of that and consider that as part of that due diligence process.
All right. We have our fourth polling question of the day. After this webinar, do you have a better understanding of Section 280G implications? Either A, yes, B, no, or C, maybe. I'll give you some time to answer this. If you just select your answer and hit the submit button, your polling question will be recorded. All right, give it about 5 more seconds and we'll check out the results. All right, let's check them out.
All right, great. That's why we definitely want to see that it's helpful. All right. With that, I think we move on to I just wanted to spend a real quick minute talking about our transaction tax projects here at Moss Adams. We focus on complex issues that come up in corporate transactions, including Section 280G, like we talked about today. But we also have very deep expertise in these other areas such as Section 382, loss limitations when there is an ownership change, transaction cost analysis, and qualified small business stock, earnings and profits, and stock basis calculations. So this webcast is actually the first in a 4-part series on these topics, with the next one being on Section 382, which is on June 11th. And so we'd love to have you join us for another one of those, or all of them, or whatever you might be interested in joining us for. And with that, I think we're going to open it up to questions. And I think we've been monitoring some of the questions coming in. So give 1 second. So we did get a couple questions about, in general, just the acceleration of stock options and how those are valued, how that gets included. I think some important considerations there is, like Sami mentioned first is, to the extent, okay, were they issued in the last 12 months? So if they do fall under that presumption, we might just include the full intrinsic value, which is usually what would be paid upon cashing it out, right? The difference between what the value is as of the date of the transaction, which that value is usually, especially if it's in a stock deal, it's usually pretty clear what that value per share is, because you can kind of see, okay, this is what the acquisition price is and what the payout is per share. And if it, so to the extent that it's in that presumption, we include the full amount. If it's fully vested without regard to the change in control and that 1-year presumption does not apply, there's generally no contingent payment. It'd be basically as if they own stock. They can exercise, but they already have that full right to it, so that nothing's being accelerated or happening upon that change in control other than they're deciding to exercise it. That would not trigger contingent payment. What we do see very commonly is, okay, the vesting is accelerated with the change in control. And there's kind of 2 different categories that happen under that scenario. The first is if the vesting otherwise would have been based on a performance. So maybe it's tied to EBITDA, or it's tied to certain thresholds that they have to meet, then that again is the entire value that's included as the contingent payment. However, there is an exception where if it is an option and the vesting was only contingent on time based, so all that the individual had to do was stay there another 2 years, another 3 years, and it's vesting over that time, then in that scenario, what we have to look at is we compare the value of we have to track how it would have vested over time and present value that, and then compare it to what the fair market value is in the transaction. And that differential gets pulled in as the contingent payment. And then in addition to that, you have to pull in some value for the lapse of an obligation to perform services. And that's just based on the regs. It's 1% of the amount of the accelerated payment times the number of full months of the acceleration. So there's kind of these 2 parts that we calculate and that get pulled into being considered contingent on the change. So as Sami mentioned earlier, I think that can make a huge difference in, a lot of times clients come to us and think, okay, we have these huge payouts for stock options, so we for sure are over that amount, but maybe they're mostly vested, or there's just, had another year of vesting, and maybe that present value, it can be significantly less. And so there are times that, that might not even exceed the safe harbor amount. Yeah, so hopefully that answers that question. I don't know, Sami, if you've seen any others come through that you want to answer. I think we've got just a couple minutes.
I think we've reached the top of the hour, Jen, and so we can follow up with any attendees that have sent us some questions after this webcast.
Sure.
And with that, we'll hand it back to Chad.
Awesome. Thank you, Jennifer and Sami, for a great presentation today. And like Sami said, if we didn't have time to answer your questions, we'll do our best to follow up with you after the webcast. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts window. If you participated as an individual and met all certification requirements, your certification is available for download now in the CPE progress window. I'll keep the webcast open for a few minutes just to give you time to download your CPE certificate. If you're unable to download it now, your CPE certificate will be emailed within 3 weeks. And also, here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you again for joining us today, and we hope you'll join us again next time.
Thank you, everyone.
Thank you.